Hello, everyone. I'm your host, Andrew Johnson, and welcome to The Art of Boring, the podcast where we dive deeper into Mawer's investment philosophy and thinking in order to make you, our listeners, more informed investors. Ultimately, we hope to connect you with the people at Mawer who find excitement in be boring, make money.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
Samir, welcome to the podcast. How are you?
I'm good, Andrew. How are you?
I've been doing well. I've been able to adjust pretty well to working from home, still able to meet with clients over video, host a podcast like we are now. So in that sense, I think things have been okay, relatively speaking.
Good.
This is your first time on the podcast. Let's get to know you a bit. Can you tell us a bit about yourself?
So I'm Samir. I'm part of the Canadian small cap team. The other half of that team being Jeff Moe, who's been on this podcast before. I've been at Mawer for 6 years now, 4 of which have been with the Canadian small cap team.
Give our listeners a sense of where your passion for investing came from, or even maybe how you ended up at Mawer.
I would say that a lot of people in this industry seem to have passion for investing growing up. It wasn't the case for me. I didn't even think of investing as a career path growing up. Where I discovered investing was really in my university years. So joining university at University of Toronto in my first year, I was really curious about different clubs and different courses I would join. Courses starting from anthropology to biology, just to see what it's like. And same goes with the clubs as well. So one of the clubs was the student-run investment club. And as soon as I joined, I knew that it's something that interested me well. It is a very fascinating topic to analyze different businesses. And also you get to meet very interesting people who are passionate about it too.
Great. Well, I know that we've been very fortunate to have you on the team for the last 6 years. So thanks for sharing that with the listeners. I've been talking with some of our teammates on the podcast about the pandemic, just generally speaking, and the economic and the market reactions that we've seen from that. With your work on the Canadian small cap portfolio, how is all of that affecting your portfolio and maybe more broadly speaking, the universe that you're selecting stocks from?
So from an economic perspective, we're going through a recession, and it's a different than a usual recession. If you think about other recessions, it would be a more business cycle driven or credit cycle driven recessions. This recession is really driven by the health policy, by the governments, and that makes it very sharp because a lot of the businesses had to stop their business activities, and it also makes it very deep as well. So if you look at unemployment rates, for example, they are 15-20% across Canada and the US. So very unprecedented or very sharp contraction of economic activity. What we've seen with the businesses that we own, a lot of them have been impacted. For the businesses that we own in the portfolio, the ones that have been customer facing, so that would be restaurant, franchising businesses, or airline related, where they've been really hit by the lockdown rules. That has been the direct economic impact to their businesses. On the offset, we've also seen large actions by the central banks and the governments in order to soften the blow. This is different from the previous recessions as well, where it takes a while for the governments to react, while this time around the governments really have taken big actions almost right away. Especially the central banks, they recognize that this cessation of business activity is really bad for liquidity. So there's concerns on that. So what they've done is they pumped a lot of liquidity to the system, which has helped. So you've seen the sharp market correction at first, but then as the governments reacted to this, the markets have went back to normal.
When we look at the portfolio itself, so the New Canada Fund, as you mentioned, what parts of the portfolio have held up relatively well?
I look at that from the lenses of fragility, resilience, and antifragility. So if you apply those lenses to the companies, the businesses that you would describe as fragile have performed worse. So these would be businesses that do not really behave well in turbulent times, and which we are going through right now as well, versus the businesses that are more resilient have performed better. And you can see that in stock performances as well.
Resilience is a word that we've actually talked about a lot around the firm. Maybe share with our listeners just what are some of the hallmarks of a resilient business model that we're looking for.
Our general investment philosophy, which is to buy businesses that are wealth creating and doing so sustainably over longer periods of time, and that have management teams that can create that value and buying these stocks at reasonable prices. That is really the features of the resilient business model. So if you look at a lot of these businesses, they have recurring cash flows. They're critical to customers' operations or to customers' lives, and they have stable cash flows. That would be one of the features.
Yeah, so tend to generate steady amounts of cash, tend to retain some of that cash as well, just in terms of capital light business models, just not having to use a lot of cash to run the business, and seem to be just less discretionary in nature. Is that fair?
That's correct. So one of the examples of that would be software businesses that we own in our portfolio, and we own more than the index really out there. And the reason why is because a lot of these software businesses do exhibit these features. They're recurring, they're very critical to customers, and they're capital light. They also tend to have better balance sheets as well, which helps them to go through the turbulent times like these.
Just very quickly, you also mentioned the words fragility and antifragility. I just want to kind of clearly define those for the listeners. What do you mean by those two terms?
These terms really describe the way systems behave to volatility or to change. So these terms were coined by Nassim Taleb in his book, Antifragile. So the fragility would be companies that are not behaving well with volatility. So many examples would be commodity producers who cannot control their prices, or they would have lower margins, higher capital intensity, many times high indebtedness. So what these businesses survive on is really stability. As long as the environment is stable, they will be out there, they'll be fine. But the world is not stable for a long period of time. And as soon as the volatility hits, their fragility really is exposed. Versus on the other end, the antifragility is businesses that really strive on these changes in the environment.
You mentioned balance sheets, and I think oftentimes a good, strong balance sheet or the maintenance of a balance sheet often comes down to the management team. And I wanted to get an understanding of your view on the management teams within the Canadian small cap universe in general, and maybe in particular our portfolio.
I would say that our portfolio has a greater share of entrepreneurs rather than the universe. That is by design. Again, one part of our philosophy is really aligning ourselves with the greater business people, greater managers, and entrepreneurs, founders of businesses typically tend to be greater businessmen, I would argue. So where does that come into play? They're typically around for a longer period of time. They've built these businesses, in many cases, for decades. They have gone through many times of turbulence. They have seen this music play a few times, so they're cognizant of the balance sheets.
Oftentimes it comes down to both an alignment with the actual business outcomes because they have a larger stake in the business because they founded it or they've been owning it within the family for a long time. But they also have a true passion for running the business. They've started this for not just the money, but to deliver a service or a product.
So where does the balance sheet come into play with management teams? These management teams have been around for longer periods of time and they've seen volatility before. They've been around for longer periods of time and they understand the importance of balance sheet in survivability of the business and also the ability to capitalize on opportunities as well. What is important is a lot of times the best opportunities present themselves in more turbulent times as well. What matters is really the relative balance sheet position. If you think about if your balance sheet is full of cash, no debt, but your competitors are also in the same position, that does not really create you a lot of opportunities. The competitors will be able to do well and survive, and everyone will be able to capitalize on the same opportunities. Versus if you have better balance sheets compared to your competitors, that is the real opportunity to strike when others are suffering. One example of that would be Boyd Group that we own in the portfolio. It's a collision repair shop chain in North America. It's the second largest player if you look at the industry, it's split between two players. One part is mom and pop players. There's a lot of them, thousands and thousands of them. Second type of the players are private equity owned chains that have been consolidating the industry by acquiring mom and pop shops. The mom and pop shops, I would argue that they're fragile by design. They have less processes, they have lower margins, and they're typically dependent on one or two people that are running these shops. And private equity side is also fragile because they tend to be levered businesses. Versus Boyd is very well positioned in this industry. They're publicly listed. They don't have huge debt levels. Their debt levels are 1.5 times debt to EBITDA, for example, compared to private equity players. A lot of them are at 7, even more than 10 times debt to EBITDA. We've actually seen one of the players, the number 3 player, Service King, being downgraded most recently to CCC debt rating, which is just a notch above the default rating. Versus Boyd Group has really drove down its revolvers and has raised further capital in the markets, even during these times, and they have $700 million cash in the balance sheet. So imagine going forward, that will be a very good position to be in to acquire either struggling private equity or mom and pop players.
Okay, so I'm hearing that not only is a balance sheet important in order to survive through something like this, but it can be an incredible asset, no pun intended, on the other side if we find ourselves in a weakened competitive environment, or if these companies find themselves in a weakened competitive environment.
Exactly.
There are a couple other things that I wanted to check in with you on. One is related to the term resilience that we mentioned earlier, especially the resilience that we've seen from the portfolio lately coming from the software-based businesses that we also mentioned. There are a handful in this portfolio. What is it about those companies that seem to fit within our philosophy so well?
You're right, Andrew, that we do have a lot of these businesses, and they do really hit the nail in terms of the features that we look around businesses. So if you think about wealth creation, what does that mean? It's having returns on capital above your cost of capital. Many of the software businesses have high returns on very little capital that is required to run these businesses. So that is one attractive feature. The second attractive feature, these tend to be very stable contractual cash flows. These tend to be very hard to cancel agreements with clients where they have to retrain their employees or reconfigure their systems just to change one provider of software to another. And one example of that would be Kinaxis that comes to mind. It is a company based out of Ottawa that specializes in software that helps large multinational corporations to do scenario analysis on supply chains. So if you think about it, if I am Unilever, for example, I have thousands and thousands of suppliers. I'm never sure if one of them will be able to deliver the products that they promised to deliver. And how is that, if they don't deliver it, how is that going to impact my other parts of the supply chain? That software really comes into play in these times when supply chain becomes more strained. During the coronavirus, there are more border closure problems, as well as many businesses are not able to operate due to lockdowns. So inventory becomes more scarce, and you're starting to have supply chain problems that you've seen in the headlines.
The other item that I wanted to discuss a little bit is around the observation that a significant amount of the revenues that are generated by the companies in your portfolio in particular are in US dollars. Why would that be? Why is that?
That is a good observation. That has been the case for a while now. We have done several calculations in the past. Around half of the portfolio's revenues, really, on weighted basis, come from US dollars. And that is strange given that we're primarily a Canadian small cap portfolio. And I think that is the result of the resilience of many businesses and the strength of many businesses that we own. Many of them start in Canada. They have a Canadian-based headquarters and management teams. And they have started their businesses in some province or city of Canada as well. But eventually they saturate Canada, being a smaller market, and eventually move south the border. And the United States is a very hard market to crack. It is much larger, meaning that there are more competitors that can play in that market, which makes it way more competitive. The margins are typically lower, and there's less of good capital deployment opportunities in the US for a typical business. Now, not many Canadian businesses have been able to do that shift from Canada to the US. If you think about Tim Hortons, for example, tried to deploy their chain throughout the US as well. That didn't go well. It seems to be a hard challenge to do versus some of our portfolio holdings have historically tried it, and the ones that tried out and succeeded just found a new opportunity, new runway to deploy capital and to have growth. One example of this would be Richelieu. They started out in Montreal, and they're a distributor of hardware. So if you think about knobs or other hardware items that you would use in architecture or around your home in renovations, they started consolidating the first Montreal market, then the Quebec market, then Canadian market. And after that, the founder and manager of that business, Richard Lord, started moving to the US and has found that runway, which has been the algorithm for now for the wealth creation, which is to buy independent distributors in the US and plug into their network.
You'll be happy to hear that I've supported the portfolio recently because I just went through the arduous process of replacing all of the knobs on our kitchen cabinets, which was both a fun and a learning experience for me.
Good, thank you.
What I'm hearing, Samir, is that having that US dollar exposure in the portfolio is not necessarily a top-down decision. It's just more bottom-up. It's more of a characteristic of a strong business that we're actually looking for.
Exactly. So here at Mawer, we very rarely tend to do very top-down decisions. Top-down decisions that we make tend to be around risk. If we see that we have too much of a certain sector or a certain risk exposure in our portfolio, that would be a good top-down decision to have for portfolio consideration reasons. Other than that, most of our decisions tend to be very bottom-up. So we have one philosophy across all of our funds, which is to buy wealth-creating businesses with good balance sheets run by good management teams that are aligned and not overpaying for these stocks. And following that process for each of our investment decisions really results in this portfolio that is more aligned in more resilient businesses that have more USD revenue exposure, or businesses that don't have much of balance sheet problems.
One very common question that we get from clients, and I'd be remiss if I didn't ask it to basically everybody that I interview on the podcast, is around our general kind of state of valuations when we're looking across the portfolio as well as the market. So I just wanted to ask you, what's your view on valuations today?
Valuations are a very blunt tool, even on company basis. We do our valuations on DCF basis, which is trying to forecast the cash flows that we think we will get from this business in the future and discounting it to the present moment. But these models also tend to be very sensitive to assumptions. So that's why we do a sensitivity analysis on our valuations as well, just being cognizant that valuation is a very blunt tool, and most of the time it's very hard to say. The same is true for the portfolio as well. We only have a very soft idea of whether the portfolio is cheap or expensive or fairly valued. I would say that it is hard to tell now, but relatively speaking, the portfolio is flat year over year. In that period of time, we've had a huge risk coming up, which is the pandemic. The risks for many of the businesses have increased. I think that with this pandemic, we'll see a lot of the secondary effects, the economic effects of it, really by the second half of the year or further. That can be more strained balance sheets or lower confidence levels by the consumers. And that increases the risk for many of the businesses, while the valuation levels have stayed the same. And that is the result of the injected liquidity by the central banks into the system. So overall, I would say that, the valuations are now about the same, but risk levels have increased.
Yeah, I think what it highlights for me when we talk about valuations is really, valuations is about really trying to predict the future, and all of the information that you have is about the past.
Exactly. We're trying to extrapolate the future out of our knowledge of the past of the business and the present of the business.
I always like to end just by highlighting an example of a stock in the portfolio that can be use to illustrate our philosophy and our process. And just given that we've chatted a bit about software companies earlier, the largest holding that we have in that industry is Anchovies. So what does Anchovies do and what do we find attractive about it?
So Anchovies, as you said, it's a software business. There's a lot of different software niches that they operate in. About half of their revenue is in contact center software. So think of when you call your telecom provider, for example, and you're trying to get rid of the agent. Well, you will first dial certain numbers on your phone, answering questions that way. Well, that software is probably Anchovies. And talking to the agent as well, that's also powered by Anchovies. The other half of the software is behind the curtains infrastructure management for telecom companies. So think about you have a 4G phone and there's a lot of happening behind the curtains on connection of that phone to the infrastructure of your provider. So for management of that, that's where Anchovies software comes into play as well. So what we like about this business is really these are very sticky software business models. Contact center, imagine changing contact center. That would make very big disruptions into your business. A lot of the customers will not be happy. Those customers tend to be very sticky and they change their providers not often. And infrastructure for telecom is the same. People don't want disruptions to their phones. Another thing that we like about this business is really the management team. It's run by Steve Sadler, who owns 13% of the business, has been running this business really for a few decades now, which is impressive. And what has been doing is acquiring different software businesses that are attractive, that really follow our philosophy as well at very attractive valuations and integrating them and running them better under this one umbrella.
Well, I'm not sure if we can find a better example of the be boring, make money approach than software for call centers and infrastructure of running a telecom business. I think you nailed that one, so thank you. I also just want to thank you, Samir, for joining us for the first time and hopefully not the last time. So I'm looking forward to speaking to you again in the future.
Oh, thanks for hosting and thanks for having me.
Hey everyone, Andrew here again. To subscribe to the Art of Boring podcast, go to mawer.com. That's mawer.com/podcast or wherever you download your podcasts. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Thanks for listening.